All right, let's get started. So you've turned in your last homework assignment, and the only other thing that you've got to do is the final exam, which is going to be next Friday, the 13th, from 10:15 to 12:15. We've talked about the parameters of the exam in previous class meetings. Has anybody thought of any new questions that you'd like to ask about the final? I haven't written it yet, so I don't know how many questions there will be. Roughly speaking, it'll be the same kind of blend of conceptual and problem-solving questions as before, where, about 30 to 35% of the points are related to short answer type questions, and the remainder is problem-solving. Aside from that, I don't have any notions yet of what's going to be on there. Yeah?
One thing about the notes, someone's probably asked this before, but can you use Word to create notes, or do they have to be handwritten?
It can be, you can use Word, it can be microfiche with like a little microscope if you want to have it really small. Yeah.
Just have the entire textbook.
You could, yeah, if you think that'll help. I think there may be a diverging relationship between success on the exam and the complexity of one's equation sheet. It's kind of what I found is that the people who know it, they need a few little reminders on how to set up a spreadsheet, but I don't know. You can do whatever you like, whatever you feel will be the most helpful. Any other questions? All right. So this is the first semester that Marshall has added 2 additional lectures to the semester. This is the first time we had that October break vacation, and so this is a new lecture that I haven't introduced in previous classes, and that's why you may not find it, I don't think you'll find it in your lecture notes, but I did post the slides on the blackboard for this lecture, and so if you want to look there to follow along or to keep the notes with the rest of what you've got, I did want to mention it's there in Blackboard. What we're going to talk about today is just some general information related to personal finance, and it's in response to some feedback I received last fall when I taught engineering economy on the course evaluations. There were a couple of people who mentioned that they felt like they learned a lot about the business side of finance and projects and so on, but they were interested in some more of the personal applications. So I was thinking about what are some of the things that I'm glad that I myself understand now that I'm about halfway through my career. There are certain things that I feel like I've done well in terms of managing my money and investments, and then there's plenty of things that I've made mistakes on and I've been timid or illogical, and so I thought I'd just kind of share whatever wisdom I've got about personal finance and then look also at some general definitions and terms and so on. So I think one of the big ideas that it really pays to understand is the idea of finance in the context of mass balance, or a conceptual relationship of the accumulation of money in the same way that water might accumulate inside of a tank. Or if there was a chemical reaction happening in a tank and you had some of the chemical coming in, some of it going out, and also the production of whatever the reactant is inside of the tank. But if you just think about mass balance and the idea of tracking inflows and outflows, then I think naturally it will help you to regulate your spending. And really early on when I got my first job, I made extremely detailed budgets related to how much I'd spend on food and entertainment, and inevitably the planning process was useful because it helped me to think through what are my priorities. It helped me to think that I don't especially value fine dining. Like I can get as much satisfaction out of a well-cooked homemade meal as a really expensive meal in a fancy restaurant. For me, just the extra spending wasn't worth it. And it was going through that budgeting process that helped me to identify what were the things I wanted to be spending money on. But what I realized is I didn't need to refer to that budget on a daily or weekly basis. And I know there's a lot of apps where you can do that, where you can scan your receipts and it'll tell you like classifications of how much you've spent so far this month in different categories. What I realized was as long as I was keeping track of my assets on a regular basis, that kind of naturally governed my behavior. And it wasn't necessary to go into the minutia of my budget. That just kind of, I limited spending to things that were important to me. And so let's talk a little bit more about this idea of mass balance, because you're going to have money coming in from your employment, the work that you do. You may receive gifts or inheritance at some point during your life. And you may also have a side hustle. So that could be consulting, moonlighting. You may have a side business. For example, my brother works at a railroad as an accountant, but then on the side, he makes and sells these wooden cutouts of guns. He's got a shotgun, an AR-15, a Tommy gun. He's got all these guns, and he sells them on Etsy. So I spent last week with him at Thanksgiving, and just every once in a while his phone will make a little ringing sound, and that tells him he's got another sale from his Etsy business. And he does pretty well with it. He also builds wheels for a local bike shop, and so, and he's got a couple of rental properties. Now that I think of it, my brother's really, he's hustling for the money. So what you want to do in order to build wealth, if the level here represents how much money you've got, you could think of it as a stack of bills in your pocket. You want it to be getting bigger, not smaller. If your wealth is decreasing too early, then that could be a risk factor that you'll run out. Now, the ideal of our project was you want this pool of assets to run dry the day that you die. You know, like ideally maybe the last bill you get bounces, right? Because there's nothing left and you're gone, so you don't care if that last check that you wrote clears or not. But you want to maximize your income and find ways to limit and minimize your expenses to only those things that actually add value. So you don't want to have more streaming services than you're actually going to be able to watch. Or you don't want to be heating your house during the times that you're not there and that there's no value being added to certain spending. So you need to look for ways to minimize expenses, maximize income, and then the other term in the equation for building wealth is finding investments that increase the pool of wealth that you got by having a high return on your saved investments. And if you're thinking back to the project, we did this same kind of thing. You know, you had in the project an assumed income for that first parts 1 through 4, and then there were expenses that you were assigned, and I gave you rates of return that you should apply on a year-by-year basis. And so what you were looking at is how that wealth accumulated over time, and without maybe knowing it, the formula that you applied was this change in asset balances each year. And what you did is you had the income minus the expenses, and then you added the investment earnings that applied. And so income minus expenses is how much you save in a given period. And then the investment earnings that accumulate in a given period are based on the previous period's asset balance and whatever rate of return applies. So you've applied these calculations before in the project. Now the idea is what you ought to do is apply these same kind of ideas in your personal spending as well. So there's a pretty famous quote that says you can't manage what you don't measure. And it applies to a lot of different things, but I think it applies to money especially, that you can't manage your money if you don't look at the whole picture on a regular basis. And this is a habit that I kind of unknowingly developed early in my career when I got my first credit card, and I was kind of worried that I was going to spend too much money. I was worried I was going to, because I've known people who they let their debt get out of control. You know, they spent more money than they could pay off in a given month, so they just paid the minimum balance, and then all of a sudden they're accumulating interest, and then, you know, maybe there's a concert they want to go to, and so then they buy those tickets, and they still already had a balance, and so the balance grows. I didn't want to fall into that trap, so I just started writing it down in a paper planner that I had while I was in college, like how much was in my checking account, what was the balance of my credit card. And so I started doing it on paper to begin with, but then I switched over to a spreadsheet at one point in graduate school. So this is my spreadsheet back in 2004 when I was working on my PhD at Purdue. And I had how much was in my Citibank account, how much was in Like I switched bank accounts occasionally depending on who had the highest interest rate or what was the promotional offer here or there. So I put in a different column for every different place that I had my money. And then what I did is I added together everything that was to the right of it. So when I was in college working on my PhD, I had some money that I considered liquid investments. Here's my credit card balance. I put that in as a minus, so that when I'm adding everything together, I've got my credit card balance is something that I owe to someone, so it's decreasing my assets. Even when I was in college, I had an IRA set up for myself. My wife had a separate checking account. Here's my son. When he was born, I opened up a college savings account. Even when he was just a tiny little baby, I'd already started what's called an educational savings account with him. So just the different places that I had money. Then when I graduated, you'll notice I have slightly different columns now. It's because I moved out of the United States. I was living in the United Arab Emirates. I had like a different financial arrangement. And I was in the habit of at least once a month, sometimes more than once a month, just kind of adding up where's the money, taking stock of how much do I owe, what are my assets, and hopefully, what I wanted to do is I wanted to see this number get bigger. I was focused on making that bigger over time, and so I didn't let spending get out of control, and I looked for ways to maximize my income. And so this idea that you can't manage what you don't measure, if you make the problem invisible and you know that you owe money, if you've got debt, sometimes it's a little uncomfortable to look at it. So when I bought a house, for example, suddenly I owed a lot of money. But I also had an asset. So what I did is I added another column to the spreadsheet that was the home's value. That was just what I paid for it initially. And then what was the balance of the loan that I owed. So, even if you've got student loans and right now your net worth is negative, don't feel discouraged about that because you've made a worthy investment. Getting an education, you're going to have a huge return on investment. If you think about what income you would have been able to earn out of high school, like working at Sheetz or working at a restaurant, maybe $15, $18 an hour compared to once you graduate and you're working at a company maybe for $75,000 a year. So you definitely can feel good about spending on your education because of the increased earning power you're likely to have over your entire lifetime. So my advice is, even if it's negative and it kind of discourages you to be in debt and having a net negative balance, just make it less negative over time and make that your goal. And still, expose yourself to the reality of your situation, because trying to forget about it will maybe just make you more anxious. There's a notion in psychology that one of the most effective ways to deal with things that makes us anxious is exposure. Like if you're terrified of heights, then the way that people really get over things is by, walking on a board that's 2 inches above the ground. And then, going a little bit higher and going a little bit higher. And the exposure therapy kind of builds up a tolerance to things that are uncomfortable. And so if you're uncomfortable about your finances, you just need to get over it, because your being uncomfortable about them isn't going to make the problems that may exist go away. And if you can kind of like take ownership and be proactive, then things are definitely going to head in the right direction. So cash is maybe the simplest form of financial assets, and it's recommended that you're going to need to have some money on hand just for your regular spending. So if you're getting paid every 2 weeks, then you need to have at least enough cash on hand to pay your daily expenses in between paychecks, like filling up the gas tank or buying groceries. And checking accounts, you don't want to have too much money in a checking account because they don't typically pay any interest. So if you had a year's salary in your checking account, then it would really be a lost opportunity for generating income that otherwise could exist if you had it in a savings or CD or bond or something. I'm just looking to see if any of these words are misspelled. I had this generated by AI, this picture, and AI is notorious about misspelling things. As smart as it is, if you generate pictures, most of the time AI, here, look at this,
Yeah, I was gonna say
Chebit
that.
card.
I don't know what that was.
So this is actually pretty good because most of the things on here are not misspelled. But yeah, anytime I generate an image on AI, I just have to think like, how is it? It's so brilliant at everything except for spelling in an image. So yeah, you wouldn't want to have too much money in a checking account because it doesn't generate any yield. Um, it's recommended that you have ready access to some money that you could use in case there are unexpected expenses like your car breaking down or losing your job or medical bills. And I've known graduates from our program who they start working and it doesn't work out. You know, maybe they don't like their supervisor, they don't like the location or the type of work that they're doing, and so they quit and are looking for something else. But if they have a cushion of money in an emergency fund, then things are a lot less stressful and more comfortable. They don't have to move home. They don't have to find a different apartment or add a roommate. So having an emergency fund is really something that can make you sleep easier at night and feel like less of a prisoner in your life. Some people call it FU money. You know, you want to have a little bit of money where if things get bad, you can rely on yourself to live and you're not necessarily a prisoner to whatever job you've got. So a good place to keep that much money, if you're thinking about potentially half a year's worth of salary, you don't want it just in the checking account. So putting it in a high yield savings account, something where you can draw on it at any time, it's not locked up like it would be for a CD, that may be a good option for your emergency fund. And then you may want to have some additional cash on hand depending on where you're at in life. Sometimes as people get closer to retirement, they may want to have some of their money locked into a guaranteed rate of return or someplace that's not going to experience a lot of volatility. So they may want to put it in savings accounts or certificates of deposits or bonds. If they were going to be retiring at a certain time, or if you're trying to build up a pool of money to use for the down payment on a house, for example, then that would kind of be considered a cash investment as well, if it's locked in and not varying on a daily basis like it would for stocks. So any questions so far about anything I've talked on so far? Okay, so we've talked a little bit about stocks. Here's another AI-generated image. I don't see any obvious misspellings. Brilliant. So stocks are basically a share of a company where you're owning a tiny fraction of the company's assets, you're owning their debts, just in as much as your ownership of their debts is limited to the value of the stock. So if you own a part of a stock if you own stock shares in a company, they're not going to come after you if the company goes bankrupt. The most that you could lose is the value of the shares themselves. But what you're actually buying is the right to their future profits. So hopefully the company will be profitable and will generate dividends, or their share prices will appreciate, and that's what you're buying. That's what you're paying for, is the future claim on their earnings. And the reason why companies would sell shares of their company is just if they want to expand, or sometimes a company will begin as a privately held organization, and the people who built the company want to cash out. They are looking for a new business venture, or they might think that their business is as successful at the moment as it's likely to be, and so they want to lock in some of their profits, and so then they sell the shares that they have accumulated in building the company to kind of cash out and then take that money, put it into other things. But sometimes even companies that already have shares, for example, Boeing has talked about selling more shares of stock. It's been a publicly traded company for a long time, but they went through a difficult period where they had a labor strike and the doors blew off some of their airplanes and a couple of the airplanes crashed. So, Boeing's had a difficult couple of years and they were running low on money, so they were thinking about selling more shares just to fund the ongoing operation until they became profitable again. I don't recall whether they're going to follow through on that because the strike ended, so I'm not sure. But they sell stocks, people buy them, trade them on an exchange, and there's typically two different classifications, two different kinds of stock. And of the two, common stock is the most common. It's where the shareholders can vote on proposals by the board, like how much the people are getting paid, like the executives in the company. That's generally put to the shareholder vote. Sometimes if the company has an offer to be taken over, then that would be put to the shareholders for a vote. The owners of the common stock also have the right to receive dividends, and sometimes the dividends will be big, sometimes they'll be small. Preferred shares, on the other hand, don't have voting rights, but often what they're entitled to is a fixed dividend, regardless of whether the company is really profitable or less profitable. The dividends are usually more steady for preferred shares. And so they're considered, if a company was going to be liquidated as well, then the preferred stockholders would receive more of the money if, in case of a bankruptcy and they're just dividing up all of the assets. Common stockholders would be last in line. The people first in line would be like companies that the company which is going bankrupt owe money to. So like the accounts receivable or something. Then next in line would be bondholders, if there were any for the company, then preferred stock, and common stock shareholders are last in line. So if the company is on a shaky foundation and not doing well, that's why sometimes the common stock will plummet in value very, very quickly. The way to make money by owning stocks is the regular payments to shareholders, which are dividends, and then if you sell the stock in the future, then the appreciation in the share price is classified as a capital gain. And we talked about in our taxes lecture on Monday that capital gains are taxed at a much lower rate than dividends are. When you receive dividends from a company, then you have to pay ordinary income tax on that, whereas capital gains are taxed at generally 15%. So it's great to get income from capital gains, and it's especially good because you're not taxed until you sell the stock, until your profit is realized. And so for years and years you can put off paying taxes. So there are some companies that are kind of notorious for not paying dividends, and it's because the executives of those companies, like Berkshire Hathaway for instance, they have a huge pile of cash and they don't want to pay taxes on that pile of cash, and they know that if they distribute the money to their shareholders in the form of a dividend, then their shareholders have to pay taxes on the profits at a high rate. But if Berkshire Hathaway keeps their cash pile and they don't disperse it, then the shareholders have that money reflected in the increasing value of the stock, and so they can get their money back in terms of capital gains rather than dividends. And so it's kind of a tax management strategy in some cases. So some companies don't pay dividends because they're not profitable yet. Other companies could pay dividends and choose not to. Stocks are generally understood to be more profitable over the long term, but it's understood that there is more volatility in the short term. That on a day-to-day basis compared to a checking account, the money only goes down if you spent money. But when you own stocks, it can go down or it can go up for a lot of different reasons. It could go down because the company has some bad news associated. Like when Boeing has a window or a door blowout on one of their planes, the share price is depressed the next day. Or when NVIDIA announces that they have a new processor and everyone's excited about it and it's going to be revolutionary, even before they've sold one, their share price goes up because good news makes people more interested in the company, and demand for the shares increases the price of the shares. And so there are some ways to know, like, what are the underlying assets, like what's the value of the company in terms of the value of their real estate and their equipment and their order book. But then a lot of the share price is sometimes just exuberance for the future. Because remember, what you're buying when you buy a stock, it's not just the price isn't related to their assets now. What you're buying is the claim of their future profits. And so if a company is thought to have really rosy prospects for the future, then their share price may be many multiples higher than what would be justified by their current financial situation. So the market price is the current price per share of a stock, and it's based on the demand for the market. And when a company first offers shares on the trading market, then it's called an initial public offering. And the share price is generally determined through an analysis by a bank, which helps to manage the initial public offering. And it's really hard to get those first shares because it's usually limited to big-time institutional investors. And just for whatever reason, to ensure that the company raises as much money as they want, they generally charge a little bit less than they think the stock will start trading at. And so if you buy through the initial public offering and you can buy a share for $25 and they expect it in the same day it begins trading, if there's more public demand, it's going to go up to $30. It's kind of thought of as instant profits in a lot of cases. So I thought we'd just take a look at some of the particulars related to companies that we know about. For example, Amazon. Over here on the right side, it tells us the market capitalization of the company. So based on the number of shares that are outstanding and the price per share, the implied value of Amazon is $2.3 trillion. So it's a really big company. Like the U.S. economy, I think, is like around $25 trillion a year in spending. So Amazon's, just to put it in perspective, it's pretty big. Here, this P to E ratio, it's the price to earnings. What it represents is the share price compared to how much money Amazon is making per share. So what you can think of it is that you're paying $46. If you wanted to buy a share of Amazon, you're paying $46 in share price for every $1 of earnings that Amazon is making. So it gives you an idea, if you're comparing stocks, of relatively speaking how expensive a company is. And historically, a pretty typical P to E ratio would be around 20. We'll look at a graph of that in a moment. But another thing here is you can see Amazon does not pay a dividend. So the dividend yield here is blank because they're at the point where they want to keep their profits and reinvest it in new projects like improving their shipping infrastructure, trying to get additional market share, building up their cloud platform, and so on. So Amazon's pretty well known. Let's look at also ExxonMobil. So Amazon's price to earning, what was it, 46? 42. ExxonMobil is an oil company, and let's look at its statistics. Its price to earnings is only 14. So what that means is for every dollar of earnings that they receive, you're only paying $14 to get a dollar of earnings. So they're relatively speaking, it's less expensive to buy Exxon's profits compared to buying Amazon's profits. But remember, the earnings that they're talking about when they calculate this ratio is the current earnings. And so the reason why people are willing to spend so much for Amazon is because people are thinking in the future, Amazon's going to be even more profitable than it is now. So that's why people are willing to pay a higher P to E ratio. But look, ExxonMobil pays a pretty nice dividend, 3.46%. That's more than a lot of savings accounts pay. And so when you buy ExxonMobil, you're getting not only the dividend, but also the possibility that their share price may increase over time. So you have the potential to make money through dividends and also through share price appreciation. What do you think would be the downsides of buying ExxonMobil stocks?
Introduction of alternative fuel.
Yeah, exactly right. They're a fossil fuel company, and there's a lot of uncertainty these days of, is there going to be as much demand for fossil fuels in the future as there is now, both because, well, populations are not growing as much as they used to be, and now there's solar, there's wind, electric cars instead of gasoline. So oil companies are still hugely profitable, but there may be stranded assets where they have oil reserves that they know about, but then there's no reason to pump out in the future. So that's kind of why some energy companies have cooled off a little bit. Let's look at some other favorites. So Tesla is always in the news. Elon Musk recently had a judge in Delaware declare that he can't have $100 billion in Tesla options that his shareholders voted that he could receive. It was rejected by a federal judge. So he's pretty pissed. He doesn't get $100 billion he was supposed to get. Are we still looking at ExxonMobil? I thought I clicked on Tesla. Let's look at Tesla. Okay, so Tesla, 1.1 trillion, a big company. Their P to E ratio is just huge. No dividends because they're not actually profitable. Or if they are, they're just getting by. Not enough to start giving people dividends. So people are paying $96 to buy a share of Tesla for every dollar of earnings. So the actual share price itself is $3.50. But what that means is that they must have about $3.50 of earnings per share to make the P/E ratio close to 100. Any other stocks we ought to look at before we move on? Think of McDonald's. McDonald's is an interesting one. I wish I'd bought McDonald's when I was in college, because I think when I was in college, McDonald's was selling for about $20 a share. Now it's near $300. So market cap $200 billion, P/E ratio 25. They've got a dividend, so pretty good company. What's a small company though? If we want to think about like a relatively small company, I bet Home Depot's Dollar General. DG. They're not a small company. They've got, market cap of 17 billion. So that's definitely smaller than Tesla. But look at that P/E ratio, 12.4. That's pretty attractive, and a 3% dividend yield. They grow like crazy. There's always Dollar Generals popping up all over the place. So stocks are an interesting way to grow your assets over time. So here's the wisdom that I wish I'd heard when I was in college is it can be so tempting to buy stocks, but if you do, you need to buy and hold. Be a buy and hold investor, because I sometimes made the mistake of panicking when it went down and then selling it, but then it went back up again. So, I didn't always buy low and sell high. Sometimes I would buy and it went down and I was worried about losing money, and so I would sell. But then over the long term, like when you put money into stocks, you should put money that you don't need for a while. Put the money into stocks that you can afford to leave there for 5 years or 10 years or 30 years. And then you won't worry so much about the day-to-day fluctuation. We've already talked about market capitalization. That's the total value of a company when you multiply the number of shares that are outstanding by the price. We've talked about P/E ratio. And buy and hold is the investment strategy that I wish that I'd done. I also wish that I'd never put more than 20% of my assets into individual stocks, because, in a way, investing is a competitive thing where you're competing against smarter people who have more information when you invest. Like the MIT graduate who's working on Wall Street has access to proprietary trading data. Their server is 1 millisecond away from the exchange, and their whole job and their whole career is just focusing on the minutia of one stock. You can't beat that person in terms of knowing something that they don't know or being faster than them. So the only way, I think, to get ahead in investing is to buy a big basket of stocks rather than focusing on one, because if you just have too much riding on one stock, then it goes down and you suffer a lot. So I think index investing is the idea of buying a whole representation of the U.S. stock market as a whole, and then just holding on to those shares for a really long time, I believe is the wisest approach to stock investing. In contrast to day trading, which is where sometimes people will try and buy and sell a stock multiple times through a day, hoping to capitalize on changes in momentum or some sort of a technical analysis. That always seems far-fetched to me, but just trying to, if a stock goes up by 1 or 2% a day, if you capture that 2% day after day after day, then in theory at least, you could have a 600% return over the course of a year. But the problem is sometimes you'll have losing days rather than winning days. So technical analysis is one of the things that day traders use. They graph stock prices, and they have all sorts of silly names for like different shapes that they see in the data. It's kind of like hocus pocus in my opinion, like astrology or something, where you're looking at the alignment of the stars and determining how things are going to go this day. Because like technical analysis, just looking at the shape of the share price, it doesn't take into account things like what if the doors blow off a Boeing aircraft, like that. Looking at the shape of the share price over the last couple of months is not going to predict what's going to happen with a company if the CEO has a heart attack, or if there is a global pandemic based on a new novel virus. So there's just too many factors that aren't represented by technical analysis for me to be comfortable using it as a long-term investing strategy. So we already talked about P to E ratio and how it represents how much people are paying for $1 of earnings. And there were times in the 70s where, on average, if you looked at the top 500 companies in the United States, you'd have to pay less than $10 for $1 of earnings. So during those years, there was just less interest in stocks because corporate profits weren't as high as they are now, and there were other investing alternatives that were doing pretty good in those years. Like bonds were especially high in the late 70s and early 80s. You could put money just into savings accounts, and they were paying a lot in those years because there was a lot of inflation in the late 70s and early 80s. So just the stock market wasn't as popular then. There was less money chasing stocks in those years compared to now. And so if you look at this huge increase in the average P to E ratio, that just represents the fact that stocks were really the only thing that were returning good investments for a lot of years through the mid-2000s and 2010s, when interest rates in other investments were really low. More money was pouring into stocks, and so by default, because it's a supply and demand that dictates the market price for a share, it drove up the P to E ratios. So the bottom line, what you need to know is be cautious of companies that have a really high P to E ratio. So for example, NVIDIA. It has a bright future, but it's also got a really high P to E ratio. Like people are paying $56 for every $1 of earnings. They do have a dividend yield, so I mean, I guess that's nice, but it's only 0.03%. So they're not giving people a lot of money yet. They probably will in the future. All right. Mutual funds are a way to capture some of the benefits of investing in stocks and limiting the volatility of owning individual stocks. And so if you pool your money with other investors and you give it to somebody to manage, then that's a mutual fund. And here we have the AI generated, that's supposed to say, I think, diversification. So some mutual funds are actively managed by somebody who knows a lot about investing and, is that MIT math major who's right there at the exchange and has all the proprietary data. So there are actively managed mutual funds, and there are also passive mutual funds, which say, we don't know who's going to be the buyer, or who's going to be the winner and loser. We're just going to buy a little bit of everything. And over the long term, very few actively managed mutual funds can outcompete a passive, unmanaged index fund, which is kind of interesting that I think over a 10-year period, 80% of actively managed mutual funds underperform compared to passive funds. So the advantage of mutual funds is just diversification, because you're buying a larger pool of assets rather than having all of your money riding on a handful of stocks. And compared to stocks where sometimes a single share will be, like in the case of Berkshire Hathaway, I think their Class A shares are like more than $100,000 for a single share. So you couldn't buy a share of their Class A, but you can get mutual funds for a really low starting amount, $500 or even less, and you can get started with mutual funds. And there are mutual funds that focus on buying stocks, and some mutual funds focus on buying bonds. Some focus on really short-term government assets, or what's called commercial paper, which is short-term loans to companies. And those are money market funds where you're in a similar to like a high-yield savings account. Money market funds are generally considered extremely safe. There are some funds, like index funds are the ones that would target a specific tracking index, like the Dow Jones Index or the S&P 500 or the Russell 2000 or international indexes, which are collections of stocks that are meant to give you an idea of how the broader market as a whole is doing. So sometimes mutual funds are tracking those indexes and they're not actively managed. So with mutual funds, the potential for steady growth exists, but you can also lose money. And so you have to have an appetite for loss. Like the last year, the stock market as a whole is up about 30% in the last 12 months. And that's fantastic. Everybody's just overjoyed with how well the stock market is doing. But you have to be willing to lose all of that money and more next year. And if you don't have that appetite for volatility, then you shouldn't be in stocks, because there's always going to be market fluctuations. And another thing to be aware of with mutual funds is that the people who offer them charge a fee for managing it. So you're pooling your money and you're allowing somebody to manage it. And you have to be really conscious of the fees, because they seem small, but over the long term, they have a huge effect. I'll show you an illustration about that in a minute. It's the expense ratio that you need to be aware of. And you also need to be cautious, because just because a certain mutual fund has done well in the past, or even maybe if their average for the last 10 years is good, that does not guarantee their future performance. So here's an illustration that shows the long-term consequence of a fund manager where you, let's say you are investing a certain amount, and over the long term, how much the fees are adding up to, or how much you're earning. If you're paying 0.5%, you could accumulate over a 30-year period $500,000. If you're paying 1%, it seems like such a tiny difference. Just 0.5% difference between 0.5 and 1, just 1% difference between 0.5% and 1.5, but it means the difference between having $375,000 at the end versus having $500,000 at the end. So these management fees, you just need to be relentless in finding good investments that offer the lowest fees. And so, let's see, do I have a link here? I think that there are some really good index funds that you can get, like Schwab 500. It's probably, yeah, this one. So it will show you their expense ratio here, 0.02%. So that's what you need to be looking for when you buy an index fund or a mutual fund, is like the expense ratio is really, really low, and then you get to keep the profits instead of a fund manager. And there are a lot of mutual funds out there that have really high rates. I thought I had a link. I must have forgotten to paste that in. There's a lot of mutual funds out there that charge more than 1%, and they're snakes in the grass. You need to really be careful, because oftentimes they can't outcompete the funds that are charging virtually nothing to manage your money. Okay, we talked about bonds before because you've calculated bond values, and so you know a little bit about the mechanics of how to value a bond. But from the perspective of an investor, the reason why you'd invest in them is because you can get a guaranteed return in a way that dividends aren't necessarily guaranteed. A company can increase them or decrease them over time depending on their profitability. But when you enter into a contract with the federal government and buy a bond, they tell you in advance how much you're going to earn. So it's more reliable, and it's lower risk because you have senior status when you buy bonds from a company compared to the common or preferred shareholders. If there was a failure and liquidation, you'd get more of your money back than the shareholders would. And there's a little bit of a correlation between when stocks do well and when bonds do well, but there's not an absolute correlation. And so you can diversify your portfolio and have money to rely on in the years that stocks are doing poorly. Your bonds could still be paying out nicely, and they have the ability to appreciate in price, and so you could earn money aside from just the interest income as well. But you know that there are risks with everything. There's default risk and interest rate risk, inflation risk, and so it's not risk-free to buy bonds. The default risk in the United States is pretty low, though, for federally issued bonds. That the U.S. government has never failed to repay its bonds. Okay, it's 12:50. We're out of time. We're going to continue this personal finance on Friday. And although there's not a homework assignment, this material is fair game for the final exam. So I think it's worthwhile to take notes and try and learn this, because I'm going to ask some questions on the exam related to personal finance.